If I told you that one of the best AI infrastructure plays of the last 12 months was a company most people still think flips phones, you'd think I was joking. But the chart says otherwise. Nokia up 62% in the last year, up 28% year to date, with the same Wall Street analysts who ignored it for a decade are now racing to raise their price targets. And the question I want to answer in this video is the question every honest investor should ask when they see a stock that has run up as hard as this. Is this trade over, or is it still one of the most undervalued trades currently on the market? In this video, we're going to look at Nokia, the numbers, the story, and most importantly, the psychology of investing into it. And if you enjoy long-term investing videos, subscribe to this channel. I post at least 5 per week. Now let's get into that subject of Nokia. But before we touch a single number, you need to understand something, because if you don't, the rest of this video won't make any sense. Nokia is not a phone company. I know many of you are going to relate to it being a phone company because you probably grew up with Nokia phones. And this is what most psychologists call an anchoring bias. When new information arrives, your brain doesn't evaluate it in a new way. It evaluates it against the first version of the story you originally heard. And for most people watching this video, the version of Nokia they knew was related to one of their first phones. But that mental anchor is costing a lot of people money. The Nokia of 2026 is something completely different. It is an optical networking and IP routing company. It builds the fiber optic plumbing that connects AI data centers to each other and the rest of the internet. Every NVIDIA chip on Earth has to talk to each other, and that traffic tends to move through Nokia equipment. So what's actually happened recently when we're looking at the stock as a potential investment of Nokia? There's 3 things, and they all happened within the last 15 months. First of all, in February 2025, Nokia closed its acquisition of a US company called Infinera. It was a $2.3 billion deal. Infinera was the 5th largest optical networking company in the world. Nokia was the 3rd, so if you combine them, you've got an almost monopoly of high-end optical cable networking. I know that sounds boring, and it is boring, but it's also one of the single most critical infrastructure levels of the AI build-out. You can have all the NVIDIA chips in the world, but if you can't move data between them at the speed of light, then that AI doesn't work. Number 2, Nokia recently announced a partnership with NVIDIA. The 2 companies are now directly collaborating on AI, networking infrastructure. That's not a press release, that's a structural endorsement from the most important chip company on Earth. 3, in December 2025, Nokia announced a $4 billion US expansion of R&D and manufacturing in collaboration with the Trump administration. They've also picked up defense contracts with Lockheed Martin to provide mission-critical 5G for the US military. So in 15 months, Nokia went from a tired European telecom equipment maker to a US-aligned, NVIDIA-partnered, defense-credentialed AI infrastructure play with a near monopoly in optical networks. That's a lot of story. The market noticed, and it went up 62% in the last year. But when you see a stock go up 62%, 2 things are going to happen in your brain, and both of them are probably wrong. The first is what's called recency bias. Your brain takes what's been happening lately and just assumes it will keep happening. The stock's been going up, so it's going to keep going up. And that kind of feeling is a similar feeling to what people had with the tech boom in the late 90s. Now, the second psychological bias is called FOMO, fear of missing out, technically known as regret aversion. Your brain is terrified of watching this going up without you buying it, and emotionally missing that trade hurts. These 2 biases, recency and regret aversion, are the exact combination that makes people pile into stocks at the worst possible time. So before you consider investing into Nokia, I want you to take a step back, breathe, and think clearly. Look at the current numbers and not the headlines. The stock is currently trading around $15. Now, the Wall Street analysts, those are the people whose job it is to price tag on every company. They've looked at Nokia and put in a fair average price of $14.50. So currently, it's basically the price that most professionals assume it's valued at. So you're not really getting a good deal. You're basically paying full price right now. The most optimistic analysts say it may go to like $17.50. That's about 15% higher than today. And the most pessimistic ones think it will go to $10, and that's almost 30% lower. So even the bullish case is not life-changing money, and the bearish case is a little bit risky. Now to the part that matters most. There's a number called the price to earnings ratio, P/E ratio. All it tells you is how many years of the company's current profits you'd need to add up to equal what you're paying for the stock today. A P to E ratio of 10 means it's cheap. A P to E ratio of 20 means it's fair. 40 means expensive. 60 means you'd better be buying into serious future growth because you're not getting a bargain on today's price. Nokia right now has a price to earnings ratio of 64. Now for years Nokia traded at single digits, 8 or 9 at most. The market basically gave it away. Now it's 64. That's not a value stock anymore. That's the kind of multiple you pay for maybe Tesla and so on. But the bulls say, yeah, 64 looks expensive today. But you have to look forward as well. Nokia just absorbs that company called Infineon, and AI build-out is still early on. They believe profits are about to explode. And when those profits show up, that scary 64 number will collapse down to maybe 20, which is more normal. So in their view, you're not overpaying. You're paying today for what the company will earn tomorrow. That's a reasonable argument. It's not crazy. Now for the bullish case. Here's where we slow down. The AI excitement is already fully priced into the stock. Nokia just lost a major contract with AT&T worth somewhere between 5 to 8% of its mobile sales. That's real money walking out of the door. The mobile side of their business is still struggling. And one major bank, Santander, has gone on record to say the rally is over and the stock should price back down to $7. That's a reasonable argument, also not crazy. So here's the honest reading. 12 months ago, Nokia was in the bargain bin, forgotten about, rolling down the hill. But that trade price is done. The people who bought it back then have already made good money. What you're being asked to buy into today is something different. You're not buying a cheap stock anymore. You're buying a bet. A bet that the AI story has years left to run and that Nokia's piece of it is going to keep growing alongside it. Now that's a perfectly valid bet to make, but you have to know the bet that you're making. And don't pretend that you're getting a good deal because you're not. Now, if you watch any of my other videos, you know I run a 5-bucket investing system. Value, growth, cash cows, deep value, and Las Vegas. 12 months ago, Nokia was a textbook deep value investment. Unloved, misunderstood, sitting on an infrastructure, assets that the market was ignoring. It's the kind of position that you would put 1 to 2% of your portfolio investment into. Today, it doesn't fit that deep value thesis anymore. It's not unloved, it's not misunderstood. 11 analysts cover it with a buy consensus. Morgan Stanley calls it a top pick. So where does it go now? In my framework, it's sitting somewhere in the growth bucket. Because I think the AI optical network thesis has a few more good years of growth coming to it. And also cash cows because the company pays a dividend. But you have to have discipline with an investment like this because there's a lot of hype around it and you may just buy into it at the top and not a good price. I would personally wait for the market to give a better fair deal price for that. And eventually that probably will happen. And this brings me to the third psychological trap and the most expensive of all, the disposition effect. The disposition effect is a well-documented tendency to take profits too early on your winners and hold on to your losers too long. It's the opposite of what makes you money. But there's a flip side I want to talk about because it applies right now to Nokia. When a thesis you got right is played out, when the trade has worked, there's a version of the disposition effect that traps you in the position. You start telling yourself the story that it's just getting started, and you ignore the rising price to earnings ratios. You ignore the analyst downgrades. You ignore the lost contracts. And you explain it away because the position's been good to you, so it's probably going to keep going that way. And that's how many good investors lose the gains that they made. If you bought Nokia early on, congratulations, you did great. But the discipline you have to ask yourself now, would you still buy it at today's price? Or would you start trimming your profit? My honest take is that if you're looking to invest in the AI infrastructure play, this is not a screaming buy position. I would wait for it to pull back a little bit. If you already own it at lower levels, remember what I asked you if you would continue to buy it at the current price or whether you may consider to trim some of your profits to get your original investment back and let it keep getting exposure. Don't be the one that's chasing this thing because of its trends and start buying in at the top and then get panicking and selling at the bottom. The hardest skill is not picking the right stocks, it's recognizing when you've won and acting accordingly. The Rothschilds didn't build their fortune chasing things. They built it waiting for the right moment, sizing the position and having the discipline to walk away when the trade was done. If this video was useful to you, subscribe to my channel. I post at least 5 videos per week for long-term investors. Thanks for watching.